guys there? Hello, hello. Ready for some training?
Hello everybody, good morning, good afternoon, good evening, good night, depending where you are in the world. Well, what is the program for tonight? What is the content of this session? So, tonight we will have another very important subject to see, and here is the content. First of all, as usual, we will begin with some recaps, and I will answer some questions which has been asked by some of the students. We will go a little deeper in the Primo's concept, and I will also recap the rules for the Primo. Then I will introduce an alternative indicator, the TDI, instead of the Vinini, and then a very, very big subject which will help you in your practice. It is the strategy tester. I will show you how to use the strategy tester to look many charts on many time frames in a very short period of time. And this will be a very important subject for you to hope to have some master or some enough master of the max before going live with the max. And as usual, I will show you some updated do's and don'ts in my last PowerPoint presentation. And so, at the end, as usual, the homework assignment. So let's begin first of all with some questions I would like to answer based on some requests of some of you. So let's go to my chart here. No, not this chart. Let's take one picture, one homework. Here you see, not this one, this one. There has been a question about the kind of Mo we have here. Why not a BTMO and why a BOMO? Remember, this is a concept we have seen in the second session. A BTMO is when the price goes straight through the home base. But at the same time, you must have the three EMAs in the right order. Here, when the price crosses up the home base, where are the three moving averages? They are here. They are not in the right order. The blue line has not yet crossed the red line. So this situation begins like a BTMO, but it does not end as a BTMO. And when the blue line here crosses up the red line, we are somewhere here in the pullback. It's no longer a BTMO. It's not a BTMO. And as far as the price moves, you see that the Mo line becomes horizontal. And remember what is the definition of a BTMO. A BTMO is when the price goes straight through the home base and the three EMA are angled and separated, and they are far from or enough far from the home base. If it is the case, it is a BTMO. If it is not the case, if the price stays too much around the home base, if the three EMAs are not angled and separated, here they are separated. They begin to show separation, but they are not angled. The red line points up, okay. The blue line points up, okay. But the Mo line is horizontal and just around the home base with the price. So this is not a BTMO. It is in fact a BOMO, a breakout Mo. And so you have the price to cross the consolidation zone here to have your Mo, your BOMO, when the moving average, the Mo line, is above the home base. This is why it is a BOMO. Sometimes you will have a correct BTMO, but the price, instead of going in or continuing in the direction of the trend, will make a consolidation. In this case, you have also to wait for the breakout of this consolidation. This is why we say it is a BTMO handled like a BOMO. Okay? So this is important to remember the definition. And the key concept is, well, are the three EMAs angled and separated? Separated, it is intuitively understandable. Angled, they must, all three of them points in the right direction and must be in the right order. Okay? So this is why this situation is a BOMO. When the price crosses here, you not have the three EMAs angled and separated and in the right order. So let's take the other example. It is this one. Here, I have had a question. Is this a BTMO? This situation. We have the price which crosses down, which comes from the upside of the, above the home base and goes through the, and below the home base, closes below the home base, and at that moment the three EMAs are pointing down, they are separated, they are angled. So we have a BTMO. A BTMO. And the next bar goes below the close of the setup bar or below the low of the setup bar. So if you trade this situation live, you must take this trade. And eventually this trade will be a losing one. If you put your stop loss somewhere here, eventually your stop will be touched. And so you have an example of a losing BTMO. You know that for all kind of Mo, you will have an average of 85% of winning Mo, but also 15% of losing Mo. This is the case. What you have to do is do not panic, wait for the next setup. The price bounce off the home base, and then it comes back from one side to the other side. It crosses down the home base. At that moment, when the price closes below the home base, the three moving average are above the home base. They are separated and they are angled. They are all pointing down. Okay, this is also a BTMO, and so you can make your trade on this entry bar. Okay, and that this BTMO will be a winning one. Okay, I hope now you will be able to make the distinction between the BOMO and the BTMO, and we will no longer ask that question. Sometimes, of course, it will not be easy to make exactly the distinction between both. Will it be a BOMO or a BTMO? Sometimes myself I have some difficulties, but don't complicate your life. Skip this trade and wait for the safe Mo. So you wait for the pullback on the Mo line, or as close as possible to the Mo line, and make a safe Mo. Like here. Here, if you skip this situation, here you have a safe Mo. Okay? This is very, very important. So let's come back to the previous example again. Ryan, we would have closed the first BTMO before the stop loss hit. Yes, yes, of course. If at a moment you see the trade is invalidated, and what is the best moment to see if the trade is invalidated? It is when the price crosses up here the Mo line and comes near the blue line, the blue balance line. In this case, you know that the waves will be finished, the secondary wave is finished, so you can say that that movement is finished, it is over, the trade is invalidated, so you can close it before it hit the stop loss, and you make some economy of pips, of course. So let's come back to this example for the Primo. Here also I would like to remember some very important concept of Primo. But first of all, let's show the PowerPoint recap about the Primo. Here, first of all, in combination with the Primo, remember we have introduced last session the second OBOS, the OBOS 5, which when combined with the OBOS 13 instead of the STOR RSI, both of them, when their tops and their bottoms coincide at their extreme scale value, this may be an indication that the price has reached an extreme, a relative extreme. But this is not the only condition for the Primo. There are other conditions. The other conditions is or are the Primo, so is an extreme. The price must be at least at the third Tiger tunnel. And remember, for normal or volatile pairs, for low volatile pairs, you take the second Tiger tunnel. I will come back on that concept. You must have a good convergence of the price, the Bollinger Bands, and the Tiger tunnels. The three must converge at the same point. All or a majority of the indicators must be at their extreme. So this means that if you are exploiting a trend, you must have some or several signs of exiting this trend. And the best the best primo will be when the price is making a rather steep angle. We will illustrate that. And so when do you enter the primo? You enter the primo mainly when the price goes back inside the Bollinger Bands and the price crosses and closes over the non-lag moving average. You have some limited possibilities to scale in during that primo, and I will show you again this evening when you can scale in. But the rule is you exit at the first sign of weakness. The first sign of weakness. And a weakness may appear in different way. The main sign is the non-lag moving average flattening, but you can also have the situation where the price meet a resistance or a support, which may be a tiger tunnels, which may be a moving average, the Mo line, the blue balance line, the red balance line, and the price is resting around that resistance zone. And so you have a weakness, you exit. You do not hesitate to exit, because as you are trading a counter trend, you may always have the possibility for the price to bounce off and resume the trend. No, it's not. It doesn't mean 144% deviation line, Ravi. I will show you that precisely. Just a moment. Just a little patience, please. With the primo, of course, you have the rule for exiting. We have seen PMX, which are the partial exit, and mainly the PXXX, the primo exit. And so let's go back to some example. Well, let's see the example I showed you a few moments ago. Here it is a 5-minute time frame. Okay. On the 5-minute time frame for normal or high volatile pair, remember I told you last session the gray tiger tunnels doesn't count. The first one is the first green. This green is the first one, the second green is the second TT, and the brown is the third TT. The gray doesn't count. The gray only count for the low volatile pairs like the Euro GBP, like the OC USD, like the USD CAD, for example. At that moment, for these pairs, the gray line, the gray TT is the first one. And so you can begin to consider primo when the price reach the third TT for that pair. That means the second green TT. So remember, low volatile pair, the first TT is the gray TT. For the other pair, the first TT is the first green. Okay? Well, the tiger tunnels are adaptative, are self-adaptative with the time frame. On some time frame, you will have more tiger tunnels. For example, in the 1-minute time frame, you will have 2 gray tiger tunnels. And for higher time frames, some of them will disappear because they are too close to the home base. It is automatic with the templates. So it's dynamic with the templates. So do not touch the template. The template works fine with the TT. If you want to see the definition of the tiger tunnels, you go to a 1-minute time frame. Let me show you an example. Here you have the pound yen. You go in the 1-minute time frame. You see here you have now 2 gray tiger tunnels. Okay? You go in the indicator list, and there you will have all the tiger tunnel. All. If you pick one of them, you will see the deviation here. Okay? For example, here 377. And if you go in the visualization panel, you will see in which time frame this tiger tunnels will appear. Do not touch these parameters. Okay? So if you take, for example, this one, you have the 0.34%. It will appear in all time frame from M1 to M15. And its color is the gray. It is the first green. It's green. Sorry, its color is so it is the first green tiger tunnels on these time frames. So sorry, here M1, M5, M15. Okay? So do not touch these parameters for each channels. So it is just for the 5-minute time frames that the gray TT here, you must make the difference between, no, sorry, I repeat. It is only in the 5-minute time frames I show, for my own purpose, the gray TT, because I often trade the 5-minute time frame. And I want all the channels for all my pairs, but I know that if the pair is a high or normal volatile pair, I will use the first green here as the first TT. If I trade a low pair, a low volatile pair, I will use the gray as the first one. Okay? Now, on another time frame, let's say, for example, the 1-hour time frame. If you trade a normal or high volatile pair, you will consider your primo at the third TT or more. If you trade a low volatile pair, you will consider your primo at the second TT or more. Okay? Now, if you want to use all these TT in the same way, in the 5-minute time frame, you can just delete or hide the gray TT so that you will not be confused. Okay? So on the 5-minute time frame, this TT, the first green, is the 0.34%. Okay? I repeat, I display the gray TT in the 5-minute time frame just for my own convenience. Well, so let's see some example. The GBPY, the GBP Japanese yen, is a high volatile pair, so we will begin to consider the primo when the price will reach the third tiger tunnels, knowing that the first tiger tunnel will be this green TT. Okay, and here we have a situation where we can eventually consider to take a primo if all the other conditions are fulfilled. Is it a good primo? Not really, because you do not have a good convergence of the price, the tiger tunnels, and the Bollinger Bands. So, personally, I prefer to skip this kind of primo. Now, here, you have a nice convergence of the TT, the price, the Bollinger Bands, and the price is coming straight from the high to the tiger tunnel. It makes a steep angle. This is the best situation for a primo. And where is your entry? Your entry is when the price goes up here. We are in a downtrend. So when the price reverses back up inside the Bollinger Bands, you have here the first blue bar which closes inside the Bollinger Bands. This will define your entry level, for example, here, when the price will go over the high of this bar. And your stop loss will be here. Okay? Here is an example of a primo, if it is taken, which will be a loss. But to take this primo, we have also to check the other conditions. Are a majority of the indicators at their extreme? The RC is at its extreme. The 2 obos, the 13 yellow, and the 5 green are both at their extreme here. The Venini is at its extreme. The Sir Erasai is at its extreme. So all the conditions are fulfilled to take that primo. Now, you see that this is compared to this bar. Let's draw a down arrow here. You have your setup. You do not have on the next bar an entry level. Okay, you do not have an entry price. So at any moment, if this trade is not taken, you have not a losing trade. Your stop loss here is never touched since the trade is not open. Later, the price comes back below the non-lag moving average, and then you have a new bar which crosses above the non-lag, which is flattening. You have another setup bar here. Okay? Now your stop loss will be there, and your price entry will be above the high of this bar. It will be here. Okay? And you enter there on this second blue bar, and this will be a winning trade. And where do you exit this trade? At the first sign of weakness. Where is the first sign of weakness? You see that you have a long bar. You know already that the long bar is always a sign of danger, a sign of a possible retracement. This long blue bar just pulls back on the Mo line, and the next bar is a red bar, and it's bounced off the Mo line. Here you see the price is beginning to retrace, so you have your sign of weakness, you exit there. You make your primo exit. Eventually, you can wait also for the non-lag to flatten here. It will be on this bar, this red bar, the third red bar, and so you can exit here, but you know it will be too late. Oops. I cannot catch my slanted line. Okay, here. There. On this bar you can exit, but there you already have on the pullback on the Mo line, you already have a sign of weakness, confirmed by the top you have on the OBOS, by the top you have on the Vinini, by the top you have on the Store RSI. So don't wait, and you have a very important sign of weakness, the long bar. So don't wait, make your exit there, here, okay? Now, as long as the non-lag stay in the right color, for example, let's suppose here you would have all the conditions. It is not the case, but let's suppose we would have the condition for a primo. For that, we should have the price on the Tiger Tunnel. But let's suppose you would have enter here, for example, and you see the price is going up, 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 up with blue bar. The non-lag is up and stay upward. The price never crossed down the non-lag moving average. And so you can accompany the price until the non-lag flattens here. And at the first sign of weakness here, somewhere here, you can exit. Okay? Now, in a primo, you can simultaneously scale in. If you have enough place between your entry price and the Mo line here, and enough place mean 30, 40 or 50 pips, you can take the risk to make a scale in when the price crosses the Mo line, because you have already a nice profit with the first entry, with the primo entry. This is why I say if you have enough place, 40, 50 pips, if the price continues and crosses up the blue line, if you have also a nice place between your last entry and the blue line, you can also take the risk to make a scale in when the price crosses up the blue line. And again, if there is enough place between the blue line and the red line, and after between the red line and the home base, and this is much more important, when the price crosses up the red bar, the red line, you can also make a scale in, which will be, for example, here at that level, or on the little pullback here, there or there. But at the first sign of weakness, exit all. In some cases, the price will continue to go upward here and will cross up the Mo line, the home base line, the home base line. At that moment, you have a high probability for the counter trend here to be not a retracement of the downtrend here, but a trend reversal. If this is the case, if the price crosses the home base and closes above the home base, you can also make a scale in at that point. Let's try to see an example so that it will be a little more clear. It's not always easy to find an example these times because the markets are less volatile. we have less ample movement. Here, for example, let's take this example. Suppose here you have the right convergence between the price, the Tiger tunnels, the third Tiger tunnels, 1, 2, 3, and the Bollinger Bands. And so you have your entry price somewhere here. Just a little remark here. It is an exception to the entry. Here you have the top of the movement. Okay? Here. You have the top of the movement. You have the highest high of the movement. If the next bar, which is a red bar, is the bar which crosses the Bollinger Bands, so the price goes inside the Bollinger Bands and crosses down the non-line moving average, if it is the same bar, so in this case, and in this particular case only, you can enter your price, your primo, as soon as the price crosses the non-lag. You do not have to wait for the price to close and to enter on one of the following bar. So in this case, you can enter immediately. Now, so you have your entry of the primo. And suppose we do not have this retracement, and the price goes straight through the 3 EMA. So you can scale in here because you have enough place. Here you have no, 10 pips is not enough. So you cannot scale in. Here, if you have enough space, you can scale in. Let's see. You have 21 pips. No, from the mauve line to the blue line, you have 11 pips. It's not enough to scale in. Then the price goes through the red line. Here you have 22 pips. It's not enough to scale in. And the price continues to go down. And let's suppose, again, you do not have this retracement movement, and the price goes through the home base here. When the price goes through the home base here, because you have all the profits of this primo, you will have a profit of around 80 pips with 2 units which are still opened. At that moment, when the price crosses the home base, for example, here, even if you are not in the conditions of a MO, a BTMO or a BOMO, when the price crosses the home base, you can add 2 units, and we also call that a MO. Okay? But this is only authorized to do if it is not a BTMO or BOMO, only if you have already, if you have always a primo which is opened. If you have closed your primo somewhere before the home base, if here, when the price crosses the home base, if it is not a legal BTMO or BOMO, do not open a new trade. Wait for a BTMO or a BOMO or a safe mo. You can trade a more risky trade because you have this profit under your hand. Okay? From the primo to the home base. Well, I hope now this is clear enough. If it is not clear enough, review this portion of the video. Okay? So Andy, why say again why you enter primo on a red bar coming below BB before a non-lag change G's color? So I have I've told you. Normally, to enter the primo, we wait for the price to come back inside the Bollinger Bands and to cross and close below the non-lag moving average. Okay, this is the standard entry for the primo. So normally, your entry bar will be this bar, the next one. Okay, you will enter when the price go below the close of the setup bar or below the low of the setup bar. There is one exception. You see here, this blue bar is the top of this movement. Okay? If the next bar, which is the red bar, if this red bar clears the Bollinger Bands and the non-lag moving average, so it goes immediately through the Bollinger Bands and the non-lag, you can enter immediately when the price crosses the non-lag. Okay, you do not have to wait for the non-lag to flatten or to change color, and you do not have to wait for the price to close. But it is the only exception. It is when there is one unique bar here which clears the Bollinger Bands and the non-lag. Okay, you got it? Okay. Well, now, I have told you the rules of the third TT or more for normal and high volatile pair, or the second TT or more for the low volatile pairs. If you follow each pair you are trading over time, you will see that sometimes the pairs will have more movement, more ample movement, or less ample movement. Remember the last quarter of last year, we had a lot of volatility in the market, and many movements were very ample. For the pound yen, for example, it was not unusual to have movement of 400, 500 pips as a daily range. Sometimes more than 500 pips. Today we are in a more normal kind of market. If you follow this kind of movement over time, you will see that at certain moment the market will be less volatile and will have more small movement. So in this case, if you observe for several weeks that the price for the normal or high volatile pair never exceed the second TT, then you can try to take your primo at the second TT, and for the low volatile pair at the first TT. But you must be very attentive, very cautious when you do that. But it is only because the market has smaller movement from some time until it will find again its normal movement. So be cautious with that. One advice: do not abuse of the primo. The primo are the most risky trade you can take. Do not abuse of them. Do not trade to trade. Trade to win the trade. So only choose the perfect setup for the primo. A question, Stefan. For the 1 minute time frame, the two gray TT would be the one TT for normal and high volatility. On the way, it's the same rule. Yes. The standard TT on the 1 minute are these TT. So this is the first, this is the second, this is the third, this is the fourth. So for the normal and high volatile pair, you will take your primo at the third or more TT, and for the low volatile pair on the second TT. I just explained you a few minutes ago that for the 5 minutes I have for my own use this special case of the TT, which normally must not appear on the template. Okay? Remember that. Normally this gray TT must not appear on the 5 minutes. Well, now to make you a little easier to catch the right moment to enter a primo, we will add two new indicators. There are not, one of them is not a two new indicator. You see here you have one non-lag moving average. We will add a second moving average, non-lag moving average. Indicator, custom, non-lag, and this time we will use as price. You see here in the parameter, 0 for the price means that the non-lag is taken with the close of the price. This time we will take the open, the high of the open of the close. So with the open, so we will put the parameter, the value 1 for the price. We will keep 13 for the number of period, a displace of 1, and the filter of 0.5, and the other parameter doesn't change. So 1 for the open, 13 for the length, like the previous non-lag, 1 for the displace, and 0.5 for the PC filter. And we'll keep the same color, lime for an up movement and red for a down movement. And you will see now, you see a small channel. You see the second non-lag. And with the first non-lag, they form a small channel. And what is important for the primo, it is when you have the two non-lag which are meeting, which are crossing here. You see here Let me draw a rectangle here. The two non-lag are crossing. You better see that they are flattening. So if you are in the conditions to enter, when the price goes down below the non-lag and you see they are flattening or they are crossing, you have your setup bar for considering entering the primo. Okay? Let's take another example. Okay, here you see the price touch the third Tiger tunnels, the Bollinger Bands touch the third Tiger tunnels, and you have here the first bar which crosses down the non-lag moving average. And as they are shifted by one bar, you see that on one bar later that they are flattening and they are quite crossing. You can wait, you can decide to wait for they really cross and decide that this bar is not your entry bar, but it is the next one your entry bar. And then you have to decide live where you will enter, there or there. So these two non-lag moving averages, as they are combined, will help you better see where the price really confirm is reversal from the Tiger tunnels. Now, if your entry is too far away from the Tiger tunnel, do not enter, of course. And how can you decide it will not be a good trade or a too risky trade? You have your stop loss here a few pips above the high of the movement, the swing high here. You simply measure the number of pips for your stop loss. You have 33 pips in this case, 42 pips in this case. If I choose to wait for the two non-lag here to cross on this bar, this entry level for me is too far away from the TT. And you see it is in the middle between the two Tiger tunnel. I don't take this, I skip this trade, even if this trade would have been a winning one. If you decide to enter here when the non-lag flattens, you have only 32 pips as stop loss. This may be an acceptable risk. Okay, so this is another advice for the primo. Based on your entry level and your stop loss, if the risk with the stop loss is too high, skip the trade. Do not take the trade. Normally for the primo, the price entry will be as close as possible the non-lag and the Tiger tunnel and the Bollinger Bands. This is why the convergence is required for the primo. And how can you estimate if the stop loss is too large? There is a simple rule of thumb. You take the length of the stop loss, for example here 33 pips, and you measure how many pips you can have until the more line or the blue line. And you see for the more line you have approximately 16 pips. This means a risk-reward ratio of 2 to 1. This is not enough. Or a reward-risk ratio of 1 to 2. It is not in your favor. Here with the blue line you have 35 pips. You have a reward-risk ratio of 1 to 1. This may eventually be an acceptable risk. This is a rule of thumb. Okay? And for the exit, indeed, you will see very often the sign of weakness, for example, like here, when the two non-lag moving average crosses, flattens, and eventually crosses. Sometimes they will cross before one of them flatten. Okay? Let's see another example. Or here you have a nice example. The price touched the fourth Tiger tunnels. You have a rather nice convergence of the price, the Tiger tunnels, and the Bollinger Bands. They are very close together. The price goes inside the Bollinger Bands on the second red bar here, and closes below the non-lag, the first non-lag moving average on the next one. So your entry price is here. Your entry level, okay? You see that at that moment, the non-lag, the two non-lag moving average crossed. So you know this is a good entry price. Your stop loss will be a few pips above the last swing high. Let's measure how many pips we have for the stop loss. 31 pips. Where is the more line? At 25 pips. The blue line at 65 pips. You have an acceptable risk here. You have quite a 1-to-1 reward-risk ratio, and here quite 2-to-1 reward-risk ratio. So you can take this trade, and you exit at the first sign of danger. And you see the first sign of danger is here. You can decide to exit very quickly. Perhaps this trade will end break-even, or with a small profit, or with a small loss, depending of the spread. But you can also decide. Here you see a long bar pulling back just on the more line, and as it begins to retrace, you exit there. Because a long bar, remember, is also a sign of danger. Okay? Now, if you do not act here or here, and you say, I wait for the stop loss to be hit eventually, then you will have another sign of danger here, you will have another sign of danger here, you will have a lot of sign of danger here, 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 etc. And you can decide to exit where you want. But the advice with the Primo, at the first sign of danger, you exit. But as long as the non-line will keep the same color, you can stay in it. So certainly not here, okay? Well, this Primo was also a good Primo, because look at here on your setup bar, or no, on the top of the movement here, on the high, or the swing high here, you had your two obos at their extreme. The RC was not at the extreme, so you had one indicator which do not agree. You have the VDN at the extreme, you have the Stochastic quite at its extreme, so you have a majority of indicators which agree with the Primo. So you can take that Primo. Okay? Now, to help you still better with the Primo, we will add another indicator, which is the TATM, the Trend Automatic Teller Machine. Insert indicator custom max TATM. It is this one. Here, no, I will not introduce it that way. I would like to set this indicator in the zone of the Stochastic. So I will just a moment enlarge my screen here, and I will drag and drop the indicator in the right zone here. You do not change the parameter. Eventually, you have a sound alert when the indicator changes color. I like to put it to false. I do not like sound alert. And you have two colors, the red and the green. You can change the green into blue, for example, Dodger blue, and a double whites to better see the indicator. And OK. So this indicator is a trend indicator, but it is a tricky one indicator. You must be prudent with it. You see, I have put the indicator in the zone of the Stochastic. The Stochastic is an oscillator with a minimum value and a maximum value. Its scale value is fixed, constant, 0 and 100. The TATM indicator has not a fixed scaled value. It follows, it mirrors what the price is doing. So it has an open scale value, but it will be limited by the scale of the Stochastic. So these indicators will give you just a visual effect. To see this visual effect, you must always observe this indicator at its far right extreme here. Do not observe what the indicator is doing in the middle of the screen, because you will have this side effect. Let's look an example. You see, as I move the chart, the indicator changes its form and its place in the scale of the Stochastic. So this is, it is the reason why it is important to always observe this indicator at its extreme here on the last bar. you have on the right on the right extreme of your screen. And conditions you will add for the primo, like here, it's the TATM here must also be at its extreme and ready to change color. Let's advance this chart one bar at a time by pushing the F12 button. You see here that the TATM is beginning to flatten. It is at its extreme. The price, the TT, the Bollinger Bands are well converging. The price is now inside the Bollinger Bands and ready to cross to close below the non-lag. All the other indicators are at their extreme, so you have a good situation for a primo. And you see on the next bar, where you can enter the primo, that the TATM is also beginning to change color. This is another sign that the primo is a good one. Okay? Let's try to find another example. I will answer the question just in one moment, just a little patience. Here you see you have a good convergence of the price TT and the Bollinger Bands. At the top of the movement, all the indicators are at their extreme, and also the TATM. And when you have your setup bar here, you see the TATM is flat and even changing colors. So you know you have a good setup here for your primo. Okay? Here we are again in a situation of a primo on this bar. Oops. On this bar, okay? You have here your setup bar. All the indicators were at their maximum, and again, the TATM was at its extreme and changing color. You have a good entry point for a primo. Okay? It is very easy to use this indicator, but remember, only observe this indicator at its extreme, right extreme. Okay? Okay, I will now answer some questions about the primo. What are the questions? Chris, can you eventually remind the question I have perhaps skipped?
Eusebio, I just put it in the chat there for you.
Okay. Okay. Do you ever enter purely on the price crossing a TT, assuming indicators are agreeable? No, no, no. The crossing of the TT is not enough. You must have also the price inside the Bollinger Bands and the price to cross the non-lag. Then, is there a confluence on TT, BB, and price at that point? At what point? Here you have a convergence. You see? There you have a convergence. There you have quite a convergence, but it's an acceptable one. The BB is close to the TT. Here you have a good convergence. The price, the TT, and the Bollinger Bands, which is very close to TT. Let's suppose this was the third TT. You would have a good convergence here. Here, look the perfect convergence of the price, the TT, and the Bollinger Bands. Okay? This is the convergence. Even if eventually the price does not retrace, but you have the conditions. And if this trade, this primo fails, you will have another entry here. The price is over the TT. The Bollinger Bands is over the TT. Then the price is inside and crosses down the non-lag. You have another entry point here. Okay? Because you have the top here and then again here. There, here, you do not have a convergence. The price doesn't touch even the Tiger tunnels. Here, the price crossed the third Tiger tunnels. It goes outside the Bollinger Bands, then the price retraces back inside the Bollinger Bands and cross down the non-lag. You have had the convergence here, but the price can go higher. Here you have a good entry point, eventually, if all the other indicators agree. And here you have also a good convergence, okay? Michael, can you use the two non-lag moving average as normal exit or just primo exit? No, you can also use the non-lag as normal exit, and this will be very useful for higher time frames. Let's take, for example, the H1 time frame. So you can see that on the H1 time frame you have, of course, larger movement. So when you are in a mo, for example, here you are in a mo. Here, perhaps, you have somewhere a BOMO, a breakout mo, okay? And the price goes up, and here the two non-lag crosses, okay? You know that here you can make an exit. An MX, for example. Then perhaps you will make a scale-in somewhere here because you have a green diamond. Eventually, somewhere you will make another scale-in here. You will make another one here. Okay, the price goes up. Eventually, you can make some other MX if you're not comfortable with this kind of situation because you have had a long bar. And here, when the two non-lag process, you can make a MX. Okay, here you have some consolidation on the tiger tunnels, but the non-lag stay well separated and goes up both. So you can stay in your trade. It is not necessary to close your trade here or one unit here, even if you have a rule which tells you after one or several long bars and several reversal bars, it is advised to take a profit here. But if you see the non-lag going firmly in the direction of your trend, and do not show a sign of weakness like they are showing here, they are flattening both, and eventually they will cross. Here you have a place to exit. Okay? So the two non-lag may also be used for exit. And in the higher time frame, you will catch much larger movement, and it will be easier to make profits. And if in the 5-minute time frame you have an average winning rate of 85%, with higher time frame you will have a better winning time frame, rates, 90%, 90 to 95% also in some time frame. Let's say, for example, the H4 time frame. Oops. You see here, let's make some cleaning. You are at the 1, 2, 3, 4 stagger tunnel here, the fourth. You have a convergence of the price, the Bollinger Bands, and the TT. All the indicators are at their extreme, even the TATM. Let's check. Yes, when you have the high here with the condition of the convergence of the price, the Bollinger Band, and the TT, all the indicators are at their extreme. The Tuobos, the accelerator is very high, the Vinini is at the extreme, the Sir RSI is at the extreme, and the TATM is at the extreme and seems to flatten, to begin to flatten. So you wait for the next bar. You have here the price closing back inside the Bollinger Bands and crossing down the first non-line moving average. The TATM is always at the extreme. You have an entry for your primo. Let's see the next bar. Now the TATM is flat, and you can make your entry. Now on the higher time frame, even if the price does not go very far, because you have larger movement, for example, even if you close here, let's take an example, you close here, you will make 20 pips, quite 30 pips. If you exit here, you will exit with a small loss, of course. But later, you can have another entry, for example, here. Oops. The price goes outside the Bollinger Bands. It goes back inside. It crosses the non-lag. So you have your entry here. and you see the price goes down. Even if you exit here, on the first sign of danger, because the price is resting on the blue line, which act as a support, you will make a profit of 240 pips. You see, a small movement in a higher time frame will give you immediately a high number of pips. So, what it is advised with a larger time frame is when you take a primo, like in this case, or like in this case, as soon as you have a profit of 100 pips, for example, 100 pips, close one unit already, and keep your second unit as long as you can along the movement indicated by the non-lag. So in this case, even if your second unit is stopped out, you will be quite a break-even, or you will make a profit. Of course, your initial stop loss will be here. It will have a value of 100 pips approximately. If you take a profit at 100 pips here, for example, you will be at 100 pips approximately. Yes, 95 there, just at their level. Once you have taken a first profit, reduce your risk. You can lower your stop loss, or you can even put your stop loss at break even. And so in this case, you have a free trade. You have one with a profit, which is banked, and the second, at worst, it will be closed at break even. But if the movement continue, you will make a larger profit. Okay, so in higher time frame, as soon as you have a first profit of 100, 150 pips, close one unit and keep the other open and tighten your stop loss. Okay, and you will see that you will make a lot of winning trades with higher time frame, with the 1 hour or the 4 hour time frame, this way. Okay. So I would like now to describe you rather quickly another indicator instead of the Vinini. It is the TDI. And for that I have prepared a template, which is my template 6C here, just for the explanation of the TDI compared to the Vinini. The Vinini, where have I my Vinini? It is not here. It is one. I must put a larger number for the parameter of the Vinini. Let's put 0. Okay. So I do not show here the SORSI, the MACD, and the TRTM. It is not essential for the explanation. And we can also diminish the size of this zone. Okay, just to have the Vinini and the TDI. The TDI is a variation of the RSI developed by Dean Malone, as you already know. And it is very similar to the Vinini, except that the green line is just a little more choppy than the green line of the Vinini. This is why, in general, the Vinini is better than the TDI. But it is used in the same manner, except with the TDI, you will not have the same view of the waves as the Vinini gives you. So do not try to delimitate the secondary waves with the TDI. But the TDI may be used this way. The yellow line shows the true trend of the price. When the TDI is up, and preferably above the 50% line, your trend will be up. If the yellow line is pointing down, and preferably below the 50% line, your trend will be downward, and you will trade short. Now, to see where to make your entry, your best entry, or the confirmation of your best entry for more entry or for scaling, will be when the green line here in a downtrend will be below the red line and preferably below the yellow line. And in an uptrend, your best entry for a more for a Mo or for a scaling will be when the green line will be above the yellow line and above the green line. Okay? But sometimes you will have also the green line simply crossing the red line and not yet the yellow line. You may have a good entry point. You will see that on the chart. For example, here, if you are in an uptrend and you are above the home base line, suppose the green line was below the yellow line, but crossing up the red line, you have a good confirmation that the Mo or the scaling will be a good one. Okay? But most of the time, you will have both the green and the red line in the right side of the yellow line. The blue line you see here are also volatility bands like in the Vinini or Bollinger Bands. And these will indicate you some very interesting situation in the price. When the green line reaches the extreme level here of 68% for an uptrend or 32% for a downtrend and is outside its volatility band, you have always a sign of weakness in the price. The price may revert soon. It will not be a trend reversal, not always, but it may be at least a retracement. So you have a warning sign here that the price is at a possible extreme. So the green line must be over the critical level of 68 or 32% and outside its Bollinger Bands. A special use of the TDI, which is called the secret rule of the TDI, is if the green line, like here, goes outside its Bollinger Bands here, but is below the 68%, it is the case here. You see here when the green line crosses up the Bollinger Bands, it is well below the 68%, then you have a place to scale in. And in general, this situation, not always, in general, this situation will coincide with a green diamond in your price. But sometimes not. And in this case, you will have an additional possible scaling. So here, at the close of this bar, you have the green line going outside its Bollinger Band, but below the 68%, you can scale in without a problem. On small time frames, M1, M5, M15, M30, do not scale in if the green line goes outside its Bollinger Bands over the critical level, 68 or 32%. Do not scale in here over the critical level in small time frames. In larger time frame, you can scale in. Okay? These are the main use of the TDI. Of course, in the TDI, you have also the same pattern as in the Vinini, the divergence. For example, you see that at the moment here you have the price making higher high and the TDI making lower high. You have a divergence, a bearish divergence. So you know that at this top of the price, you may have a possible exit or MX, like the divergence in the Vinini or in other indicators, the RSI, the OBOS 5 or the OBOS 13. Okay? So this was a quick presentation of the TDI, so mainly the same use as the Vinini, except this specific rule for additional scaling you do not have with the Vinini, but the disadvantage is you do not see the waves as easily as with the Vinini. So it's up to you to choose one indicator or the other, but do not use both. They are quite redundant. Okay? And now we are going to see for a few minutes the last point of today, which is the strategy tester. So the strategy tester is a tool. It is an EA called EA empty. You see here EA empty, which allows you to replay a chart, a past chart, as if you were real time. To use it, you must proceed as follows. I will enlarge my screen so that you see better. And I will send you the strategy tester, of course. You push on View here, View, Strategy Tester. You have the panel for the strategy tester which opens, and you have to fill all the fields here in this panel. So you choose the expert advisor, which is EA empty. You choose the symbol of the pairs you want to test. You have the list here, and you choose, for example, the pound yen. You choose the time frame you want to test, for example, M5, the 5 minute. Then you choose a model. You can choose a replay of the historical quotes tick by tick, or, for example, open price only. If you open price only, you will see each bar displayed one after one at the open. If you choose the tick, you will see the price moving tick by tick as it is stored in the historical files of the MetaTrader. You check here the use date, and you can choose a starting date and an ending date. You check visual mode so that you will be able to see the chart displayed. And then when all your parameters are chosen, let's choose, for example, a date here, but let's keep 31. Here you will have a cursor which will allow you to define the speed of the replay. So let's take for a small speed, and you keep on the start button. At that moment, you have a new chart which appears with here the notation visual, which reminds you that you are in the strategy tester. And on this chart, you can apply your template as a standard chart. Let's take, for example, our last template, which will be the 6th template. Okay? And you see that here we are at the 31 of July, okay, which is the starting date we have put here in this field. And as we have chosen a small speed, the chart moves very slowly. If we choose a higher speed, you will see the chart moving faster when you push on this button, start. Okay, this is a stop on-off button. If you push the chart stop. If you push again, the chart moves. Okay. Please add default parameter of TDI correct when you email the indicator or some input. No, there are standards, Stefan. So you can change the speed of the chart. You can make the chart going slower or going faster. And that way, you see that the price change tick by tick, but you see also the indicator changing tick by tick. So you replay the chart as if you were trading it live, okay? And now you see here the effect, incidentally, the effect of the shift of the 3 moving average. You see, you have the current bar here. Let's take a slower speed. You have the present bar here, and you have the red balance line, which is shifted 8 bars to the right, the blue 5 bar, and the yellow 3 bars. Okay? You see the indicator. One indicator which will not work with the strategy tester is the signal bar. The signal bar will always show you the last value in the chart, live. Okay? No, we cannot put orders with this EA. There are other versions of strategy tester which allow you to put order, but just for training, you don't need them. When you see a setup which allows you to open a trade, just make a temporary stop, take the price and note it on a paper, and then continue your trade. It will be much, much easier for you to train, to recognize a right setup with this strategy tester. Okay? And the replay will stop when the chart will reach the end date you have put here in the second field of the date, which will be, for example, here the 31 of August. And if you want to stop your display, you push on the button stop. Okay. You close your chart, which is a temporary chart, and you close your strategy tester window. Now, just to illustrate you the use of this strategy tester, how we can use it to train ourselves, let's do a small exercise. So, show strategy tester. I use the same value as previously. The system MT4 memorize the last value, but let's change the date, the starting date. Let's change, for example, let's take the 8th of July. I don't know what the price have done that day. We will see. And we make start. Okay, so you have the chart. Let's stop the chart. We'll begin the 7th of July, no, the 8th of July at midnight. So the time is, my time here, midnight, is the time of Brussels, Paris, or Frankfurt. It will be, of course, for each platform, the time of the server of your broker. Okay? Let's put the template we need to trade. And let's start with the higher speed, for example, 31. And let's look what the price will tell us. So here we are at 10 minutes after midnight. For me, it is just the Australian and the New Zealand market. It is not a time adequate to trade for me. So I wait until eventually the Tokyo Open. It will go fast to eventually consider to take a trade. So let's wait for the Tokyo market to open. We are now at 50, 55, past midnight. Now here we are at 1 hour AM. So Tokyo opens, and let's observe what will happen. We see, let's stop momentarily the chart. What we are seeing now? We are seeing that we are already far in the trend, which began here with a BTMO, which must probably be handled as, no, not as a BOMO, because you don't have, oh yes, it may be considered as a BOMO here, because you have spaghetti in the moving average. So if you trade the beginning of that trade at the end of the previous day, you have to take a safe move here, okay? But we see, we want to trade here at the open of Tokyo. So we are already far in the price. So we will wait for a nice pullback on the Mo line. Okay, we see that the three moving average are well separated and well angled, but we wait for a setup, for a pullback or for a red diamond, which will probably appear here near the Mo line. So let's wait. Let's go. Let's stop here now. You see that the MACD becomes red here. Here you had a small pullback. Okay, let's make a zoom, you will see better. You had a pullback, which comes rather close to the Mo line. And now we have the MACD turning red. We know that if this is confirmed, we will have a green, a red diamond, so a place to scale in. And as we are not far from the Mo line, we can take that scale in. So I decide to enter here, okay, at that level. Oops, here. I open my trade here, and it is a scale in. It is not a Mo, of course. If I had entered here, it would have been a Remo, but I enter here, it is for me a re-entry. Okay? Re-entry. I put my stop loss somewhere around 50 pips. Here on the last high, swing high, we are too close. Here above the blue line and the the Bollinger Bands, we are around 50 pips. So I know here somewhere I will have a good stop loss, a safe stop loss, emergency stop loss. And now we are in, so let's go. The price retraces somewhat. Boom, it goes down. We have a small retracement. It continues to go down. It continues to go down. So now let's make a pause here. We are at the Tiger Tunnel here, okay? Let's measure how pips we have already as profit here. We have 47, 45 pips. And we have apparently a Tiger Tunnel rejection. We know that when we have 35, 40, 50 pips profits for a volatile pair like the pound yen, we must consider any sign of weakness to allow us to bank a profit. The price has reached the Tiger Tunnel and seems to reject it. We have a long bar, so we have two signs of weakness here, which allows us to apply a rule. To rule, in fact, to bank a profit. But let's wait for the next bar to see if the rejection here is confirmed and to see if we will see a retracement for the long bar here. Let's wait just the open of the next bar. Yes, we have a bar which retraces back. So we have had the rejection of the Tiger Tunnel. So I bank my profit here and make a MX. Okay. And we continue. And of course, I can now reduce my stop loss to reduce my risk. We have banked a profit of 35 pips. The stop loss on the remaining open unit is 34 pips. So now if this stop loss is it, we are break even. Okay? We have no profit, but we have no loss. So let's continue. The price retrace, oh, it's come down. Okay, it's continued to go down. And you see, we have a confirmation here of the Tiger Tunnel's rejection. You see, as the Tiger Tunnel serves as a support line. And now we have perhaps a chance for the price to go below. No, it doesn't go below. It retraces. Okay, now I stop here. What do we see? We see the price is retracing, and it is here that you traders, future maxers trader, you have to have courage to stay in this movement. Even if the price go higher, the level you have banked a profit, and the price seems to go close to your entry level. You know that your worst exit will be here. If you exit here, thanks to this profit, you will be break even. So you must have the courage to stay. And as you see a retracement, you can now prepare your next scaling. You have a nice support line for this retracement. And when the price will cross down this support line and the MACD will turn red, we will have the conditions to scale in. Let's see if this happens. Let's restart the chart. Okay, let's stop here. We have the red bar here which has crossed the support line. Do we have the MACD red at that moment? No, not yet. It turns red on the next bar. So this is not our entry bar. The next one will be the entry bar. Where will we enter? We can draw another support line now here with this low and the low of this red bar. And we are already below the support line. As soon as this bar turns red, if the MACD is still red, and also you see the line is forming a top, the Obos is forming a top, the Vinini is not confirming, okay? But it's forming a hook. If this hook, which is inside its volatility band, and close the yellow line is confirmed, I take the entry. And yes, Michael, we could have considered a primo, indeed, but I did not took this primo because our entry bar is this bar, okay? Yes, I had the rule that this bar is the first one after the low which cleared the Bollinger Bands and the non-lag. I could have entered as soon as the price crossed up the non-lag here. But I have not been attentive, so I have missed this primo, okay? Let's continue. I have my support line here. I know I will have an entry if the price here turns red. Let's continue. Well, now I'm in. You see, the price is below the support line and is red. It is even lower than the low of this bar. All the indicators now are pointing down, and the MACD is red, so I make my scale in here. Eventually, if I want a better entry, I can wait for the price going below the non-lag. And let's draw a vertical line. So let's wait for the price going below the non-lag. Okay, we are now in here, okay? And so we have our SC1 here. SC1. No, I'm not against the non-lag since I am below the... I have crossed the non-lag, so I am in the right side of the non-lag. I would be against the non-lag if I would have made my entry above the non-lag. But as soon as I have crossed the non-lag, you see the first non-lag is already flattening. So it's good for me, and I am below. I always enter at the market, never with a stop order, always at the market. So now, let's continue. So here we have made a scale-in. Let's continue. Okay. The price continue. You see you have angle and separation which are more important, so that's a positive sign. The price advance, it passed the Tiger Tunnel. Now stop, let's make a stop here and let's analyze this situation. What do we see? We see that the OBOS is turning up, forming a bottom. Okay? You see the Winini is ready to form also a bottom. But we see another point. We see a divergence which is perhaps appearing. This low is higher than the previous low. And you have the same thing with the store RSI. The low is not yet formed. But we see that this low, if it is formed at that level, it will be higher than the previous low. So we have manifestly a divergence which is taking place. So if this is confirmed, we will have here a place to exit. And as we are already far in the trend has begun well before even the previous day for me, it will be a nice place to make an XXX. So let's continue and let's see if the bottom here will be confirmed. And yes, we have crabgrass. We have crabgrass and a long bar. So eventually, you can make a MX here. Right, Anthony? Let's continue. Okay, now on this bar, when this bar closed, you see that here the OBOS and the STIR RSI have formed their bottom with a divergence. We have the divergence here, which is clear now. And as I am far in the movement, so I decide here to make a XXX. And I will wait for the next possibility to re-enter. Okay? 3 bar? I don't understand your last word, Anthony. What do you mean? 3 bar? I don't understand, Anthony, what you mean. How many pips have we made on this on this trade, if someone 3 bars going short, yes, even more than 3, 1, 2, 3, 4, 5. So you have another rule for exit the 3, 5, 8 rules. Okay, you have a convergence of several exit rules. So you cannot miss this exit if you master all the points of the max. Okay. So if somebody can take a pen and count the number of pips we have made on this trade. So here we made our re-entry with an MX here. 39 minus 6 for the spread. 33. Ah, Vanessa, nice. 33 plus here 62 pips. And then on these scalings, we have made 24 twice. How many pips? 143 pips. Okay, in how many times? 17, 18 bars, which means 90 minutes, 1 hour 30 minutes, 1 hour and a half. 1 hour and a half with a small movement of just 70 pips, we have made 143 pips. Isn't it nice? But you see that for that, you have to act quickly and you have to have a perfect mastering of all the rules of the max. And whenever a rule or several may be applied, you must apply the rule to take the profit, to bank some profit, to enter, to scale in, or to exit quickly. Okay? So I encourage you to often practice this exercise. Whenever you have 1 hour to spend, 1 hour to spend, take a chart, anyone, choose a time frame, anyone, go in the past as long as you can and test. Eusebio, you didn't take into account how many tertiary waves had formed. Yes, that's right, Josephine. It is something I do at the beginning of my trading day to choose the pairs I will follow in priority. Here it was just for the sake of the practice of the exercise. Eusebio, it seems like timing is critical. Do you use script to enter and exit? No, Sam. I always enter manually. But I use, I will show you the next time for the exit, for the stop loss, because of course, whenever the price advances, we will have to adapt our stop loss. Of course, for example, when we have scaled in here, we adapt our stop loss here. And when we see the price advance, well, if we have not yet decided to make an exit because we see the price make a long bar, we can always tighten our stop loss. So what I use for my stop loss, it is an EA, a drag and drop stop loss. Drag the stop loss by the mouse. The stop loss is associated with the horizontal line which is drawn on the chart. And if I move my horizontal line with the mouse, the stop loss will be automatically adapted for all my units open on this pair. Okay? And this is very, very practical. And when I want to exit, all my units, for example, here, how many open units I have? I have 2 minus 1, 1 plus 2, 3 units. So I must exit 3 units here. How can I do? How can I do? I hedge if I have the possibility to hedge or not. Now, as you cannot hedge with the new NFA rule in the United States, you have 3 short your opened units. If you buy 3 units, you close all your units at a time, in one time. My broker allows me to hedge. If I buy 3 units, I am now 3 units short and 3 units long. I will have to go to my trades and to make a multiple close buy to compensate each trade, each long trade with each short trade. Okay? Wayne, in this case, would you consider using a TT as a possible resistance level to continue to stay in this move with confirmation of the Vinini and TDI still in favor of the short despite the divergence. Yes, indeed. If we are soon enough, still early in the trend, and I see a divergence, even a divergence in the Vinini or in any at the indicator, I do not make a XXX. I make just a MX. We never know what may happen with a divergence. At the beginning of a trend, I just make an MX. If we are far in the trend, and far in the trend is often after 2 or 3 scalings, if there is a divergence, I make a XXX. And if the trend resumes, because indeed we are in the right side, in the good side of the tiger tunnels, which here will serve as a support for the down movement or as a resistance for the up movement or the retracement, I make an XXX and I will wait for the next opportunity to re-enter. Okay? But it's up to you. It depends of your risk averse. If you are a risk taker, you can simply make an MX here and protect your profit, protect your open unit, and see what will happen. Just for 2 minutes, let's see what happened after this this movement. So it seems that the movement resumed to the downtrend. No, it doesn't confirm. And we see that the OBOS and the story RSI tends to turn back up. And now we see you see the effect of the divergence here. The retracement happen. It doesn't happen always, of course. Huh? And now the Vinini indicate that the waves probably will finish soon. So let's stop here a few moments. What do we see? We see the MACD turns red, okay? We have a green diamond. We have had a pullback right on the Mo line. We could say here that we have a REMO, a possible REMO. Will I take this REMO? The Vinini does not confirm the REMO. It is above its yellow line. And it is not pointing down. I will not take this REMO. I will wait for the Vinini to point down and preferably to cross down its yellow line. And we see also another phenomenon. We see the Bollinger Bands narrowing here. And eventually, if they continue to narrow, they will form a squeeze. It is not yet the case here. For the pound yen, a squeeze will be for a width of the Bollinger Bands less than 50 pips. It is not yet the case, but let's be prudent. Perhaps the price is entering a consolidation zone. If the consolidation zone is confirmed and we have the right setup to take the REMO, we will take it. Let's continue. Okay, here we have the red bar crossing down and probably closing below the non-lag. So you have another possibility for a REMO here. The Vinini begins to point down, okay? But at the same time, now we see the Bollinger Bands continue to narrow. And now we are quite, not yet, but quite in a tight zone, in a squeeze. Here I prefer to wait. We see the price is making a consolidation zone, so I prefer to take the REMO for the price to confirm it wants to go down. And so I will draw a line which will be the support line of this consolidation zone, and I will take the REMO if the price goes below that line. Okay? Let's continue. And you see, in this kind of situation, you have to be patient for a new tertiary wave indeed to begin. and the trade is invalidated. So if you had enter here, you will have probably a losing trade or a trade which will last a long time before to confirm the down movement. So let's stop here. You see that the Bollinger Bands continue to tighten. Are they now forming a squeeze? 45 pips. Now we are in a squeeze. And now, as we are in a squeeze and you see this Bollinger Bands is quite horizontal, I will only enter in that down movement if the squeeze is broken at that level, not at that level. Okay? This needs patience. And this patience may last several hours. And this is especially the case during the Tokyo sessions. Okay? So I advise you to review this video to see the thinking process to take the trade, how to enter a re-entry, a scale-in, a MX, an XXX, a REMO, etc., etc. And whenever you have a situation which seems to you to be a good situation to enter a trade, always ask yourself, are all my conditions well fulfilled to open the trades? Am I not in a special conditions which would prevent me to open the trade? If there is no counter indication, enter. If there are serious counter indication, skip the trade and wait for a better setup. As a trader, you need to know what you want in trading. Do you trade to feel emotions or do you trade to make profits? Personally, I trade to make profits. If I want to leave emotions, I have other way to do that. So, and as I consider trading, as it is my full-time activity now, I consider trading as a business, I take this business very seriously. And so I only choose the setup which are as perfect as possible. Okay? Well, so, homeworks. So, I will ask you several homeworks now. The first homework, I will ask you to scroll, to take a pair in a 5-minute time frame. And you scroll this pair from the beginning of the history you have on your platform. And you count all the possible primo. You count them. And if the primo can be taken, you count how many primo will be winning primo and how will be losing primo. Just that, just a statistical homework. How many primos, how many will be winning, how many will be losing. And give also that numbers in percentage. Okay? A second primo. A second homework, sorry. You will take a demo trade as you have done these last days. Take a live demo trade and exploit everything you can exploit. BOMO, BTMO, REMO, re-entry, scale-ins, MX, XXX, Primo, etc., etc. All you can trade them, and post your trades, your chart on the Google group or for the graduates on the forum group. And a second demo trade, you make the same exercise I have done just here. You try to make a complete max trade with a Mo entry, one or several scale-ins, one or several MX, and a XXX, eventually a Primo. But do that with the strategy tester I will send you. So one demo trade and one with a strategy tester. And for those who have enough balls, try to begin to trade live. Try to make a live trade, but be prudent. If you do not feel comfortable for the moment, do not try to trade live. If you feel comfortable enough, try, but with the minimum possible trade size. Okay? If your brokers allows you to trade micro lots, take 1 micro lot per unit. If your broker allows you to trade mini lots, take 1 millilots per unit, but not more, and only if you feel comfortable, okay? What you can post, do not post your statement, post simply the chart you will have marked, and I have done here, and post simply the chart, okay? Yes, only if comfortable. So now a few minutes for question and answer. Is everything clear enough? No, there is no other use for the TATM, Vanessa. Only Primo, yes. The TATM allows you to see a relative extreme for possible Primo. It confirms that an extreme is an adequate one when all the other conditions are fulfilled. Crystal clear, Arnold? Fine. Have I missed important question, Chris or Craig? Yes, the homework will be due to Monday. Yes, Monday midnight East time. Monday midnight East time, so that you will have Sunday and Monday to trade demo or live if you feel comfortable.
I think you caught all the questions, Eusebio. Thanks.
Ah, okay. Well, so
But
is that a valid Primo after your x86? Yes, it was a valid Primo, indeed. It was a valid Primo because we had previously a good convergence of the price, the Tiger Tunnels, the Bollinger Bands. Here we went even after the Tiger Tunnels, and we would have... No, it was not a good Primo because here it is only this bar which closed above the non-lag, but it is too far away from the from the bottom. It's a long bar here, so it's not a good entry for the Primo. Okay? The entry must be as close as possible, the non-lag and the Bollinger Bands and the extreme of the price. How many waves in the chart? I don't understand your question, Andy. Tertiary wave, secondary wave, primary wave. Here, let's make a zoom out. You have one secondary wave for the moment, which is not yet finished, and you have 1, 2, 3 here or here, 4, 5, 6 waves already. Okay? 6 wave. This is why on the 6th wave here, 5th wave, you have the 5th here, the 6th here. You must be prudent with your entry and mainly with your exit. Okay? Will you give us an EA that closes all open units in x86? I don't have an EA which closes all. I have simply an EA which monitor a stop loss. But you can find this EA easily on some Forex forum. You look for stop loss EA and we'll find. But if you want, I can give you the EA I'm using. And you will also find many scripts on internet which will allow you to close all your open trades at once. Okay? So I wish you a good weekend. I wish you a good homework. I wish you good trades, good demo trades. And if you take the risk to make a live trade, I wish you, of course, good live trade. So see you Tuesday. Tuesday will be a very, very important session. It will be the last session, but with a very important and heavy subject. It will be the risk and money management aspect of the Mac system. So, bye-bye. See you.